Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time, and this week, guys, I got a good one for you. We're going to talk about breakouts and why some breakouts fail. You know that mantra, oh, don't take breakouts. Breakouts always fail. Take the shakeout of the breakout. Well, there is some truth in that statement. You know, buying the bottom of a breakout, or if it gets a shakeout or a bottoming tail or a green bar ignored or a picture of money, etc. and so forth. Those things can be very, very profitable. However, not all breakouts fail. The problem is how you guys are applying them. There's lots of different ways to apply a breakout, and on top of that, there's lots of different opinions of what a breakout really is. So today we're going to talk about those two things. We're going to talk about the difference between a proper breakout and just a breakout. See, stocks can break out and move higher, and it's called a breakout, but it's not a tradable breakout. So we're going to talk today about what a tradable breakout looks like versus a non-tradable or untradable breakout. And we're also going to talk about the nuances of what makes breakouts good versus bad. Okay, so where they come from, how they form, etc., and so forth. So it's a very powerful lecture, and I'm doing it because I want you guys to understand that pretty much every pattern works when it's applied properly. And the problem people have is they don't apply them properly. Like, oh, well, it's breaking out above a new high. It's a breakout. No, what if it got there 9 bars in a row up? That's not a good breakout. So we're going to talk about a lot of that stuff today. You also obviously have to apply good money management and good trade management strategies to every trade that you take. Otherwise, you could turn the best trade you've ever had into the worst nightmare that you've ever had. All right? So guys, if you like these videos, man, start watching them. Start hitting me up in the comments. Why? We're not getting the views we used to get. I'm commenting because I'm just going to stop doing them at some point. No, it's just not worth the time. So lots of great content, lots of great videos, but the views are woo. So if you want me to keep doing these videos every week, tell your friends, tell your family, spread the word. I'm not kidding, because I'm going to stop doing them. It's just not worth my time. It's free content. It's free material. So take advantage of it. All right. So I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is good versus bad breakouts. Yes, breakouts. See, this was the first pattern that really got me interested in trading, okay? And the funny part about this particular pattern is that I was told, and we're going back 17, 18 years now, I was told, don't trade breakouts. Breakouts always fail. Here's the good news. I was told that from day one, and I've made a lifestyle out of breakouts and 3-bar plays. So clearly there's some truth in what they say, but mostly there's not any truth in what people say. Breakouts always fail. Guys, all bad patterns fail. Good patterns generally work. So now today we're going to talk about good versus bad breakouts. How do we find good breakouts? What is a good breakout? What does it mean to be a good breakout? And I've done lectures on breakouts in the past, but I've changed this one up a little bit. I think there's a couple slides in here you've seen before, 3 or 4 out of 20 some, but 75% of them are relatively new, because I want to talk about this topic. And this topic isn't just really breakouts, even though that's the focal point today. This topic is also applies to all the patterns you take. There are good patterns and there are bad patterns, even if it's the same pattern. And you're like, what does that even mean? There are good 3-bar plays and bad 3-bar plays. There are good biceps and bad biceps. Look, the basic of everything isn't that good. Let me repeat that. The basic of everything or anything isn't that good. I can sit here and tell you, oh, it's got 2 lower highs and 2 lower lows. It's in an uptrend. That's technically a buy setup, right? Technically speaking, right out of the Professional Trading Strategies book. 2 lower highs and 2 lower lows in a stage 2 uptrend is a buy setup. But they're not all created equal, just like breakouts. So we're trying to get you guys to think the difference between a good one and a bad one. All right. And then, of course, you have to apply good money and trade management, because you can take the best trade, best pattern you've ever had in your life and turn it into your worst nightmare if you do something foolish. So we're going to talk about good versus bad breakouts today. But before we do that, let's first talk about when will the insanity stop? This one, as you can see, I didn't get that long ago. I got it like 10 days ago. And, I put this person's name, I blurred it out for anonymity purposes, and it's actually a 2-slide email. But it all started with a 56R month. Yep, 56. That's how this person wrote it. I get these quite frequently, but I'm going to focus on the areas in pink, all right? And it says, as I look back, I made 3 grave errors. 1, I traded in much larger size than the account warranted. Is anyone doing that? I wonder. You're trading much larger size than your account warranted. Most people. 2, I did not honor my stops. Anyone done that before? Probably. And 3, the worst one, I attempted to trade through some physical and psychological issues. Ooh. We've probably done that when you're not feeling well, or you've had an argument, or just whatever, you didn't get enough sleep. So it's sad, but honestly, when you read those 3 things, I think a lot of traders do those things. Dare I say most traders do those things. So within 120 days of opening my account, I was down 40% within 120 days. But I felt that I had gotten that out of my system, so I used some available funds and added back the amount I had lost, plus about 50% more. Right? So if this person, hypothetically, if they had $100,000, the account went down to $60,000, they added $60,000 plus another $50,000, so that now they have about $150,000 account, right? So then came the 56R month, which I had managed better, had I managed better, I would have made 100R, okay? Seriously. And no, this wasn't GME or AMC, okay? The confidence boost those results gave me was incredible, and I was totally unwarranted, right? So this person is admitting, hindsight, of course, they were just lucky. It's rare that people admit this, but they were just lucky. Thinking I now had it mastered. Imagine that. Have you guys ever felt like that? I now have the markets mastered. Yes, everyone does, especially the new traders. You have one really good month and you're like, Jared, you send me these thank you emails, and I tell them, congratulations, I'm happy for you, but there's still some bumps in the road ahead. Okay. For the next several months, I traded a bunch of thin crap stocks without any sort of plan. I had a few big winners and some losers. Well, I knew they'd come back, so I pulled stops, and worse, I averaged down. Such a dumbass. I want you to read that last line. I pulled stop losses, which means I had them in, but then I chose not to take them, not to adhere to them, and I averaged down on losing positions. Okay. But it got worse when I had some medical issues. Blah 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 blah. Okay. Let's go to the next one. I was diagnosed with an incurable motor neuron disease, 100% fatal. Not a good probability trade to be found there, okay? So I skipped through a lot of stuff, all right, including writing a couple stocks down 80%. I went cold turkey and I stopped trading altogether, okay? But then this person, they were having physical issues. This is what they were alluding to earlier. And they were basically given a death sentence, okay? So to sum all of this up, because you can read it all if you want, but we don't have time to read it all right? So I'd say I learned this along the way. When you're starting, that potential loss in the face, remember, it can always get worse, all right? Sorry, when you're staring that potential loss in the face, it can always get worse. There's the two things they're referring to here. One, not taking your stop loss. It could get worse. And two, the ultimate stop loss. That's your life, right? Have a plan, size right, honor those stop losses, take the gains, and make sure to step away from the screen to live life while you can. Otherwise, it's just insanity, okay? This person is losing their life, all right? They have a disease that's incurable, all right? So there's a couple things to learn from this. One, do what the person says. Have a plan. Proper share size. Honor your stop loss. That's the trading aspect of this. Okay? That's the trading aspect. The human aspect of this is live your life. Stop to smell the roses, which is one of the reasons many people want to do this business, is so that they have the opportunity to stop and smell the roses. But while you're learning, while you're in the struggle, while you're doing battle, have the objectivity and the mindfulness to step away sometimes when you know you need it. Right? So this is someone who I have a lot of admiration for, who said, I'm willing to share this so that other people can learn from my experience. So right now, since the diagnosis, my first priority has been maximizing quality time with my family. Okay? You need to do both. Maybe you don't have a life, a death sentence in life. This person does. All right. So take this for both sides of it. One, the mistakes this person made with trading and realize them a little late, but realize them. And then appreciate what you have. Appreciate the opportunity and always use proper money management. So that's really what it comes down to. Okay. It is about the journey. Okay. It is about the journey. And it just says at the bottom, I just wanted to thank you for always being real in your videos and your approach in trading. Bam. All right. So heed the advice. Why? Because somebody used to say this to me when I was in high school. Is it so bad that it couldn't be worse? And for 99% of people, the answer is no. It's not that bad. It definitely could be worse. That's true for 99%. There's that 1% where no, it really couldn't get worse. It's kind of hard when somebody's given a death sentence to say it could be worse. All right? So it can always be worse. Make the best and the most of it. So now let's dig in. All right? Let's dig in. What type of play is a breakout? So this is one of the slides, one of the few slides that you have seen before. Okay? The bottom area of this slide you have seen before. A breakout is the point in which a stock, I hate when I find errors as soon as I start something. A breakout is the point in which a stock moves, all right, moves above or below a trading range, usually away from support or resistance. Okay? But what type of play is it? Right? So we know what a breakout is. It's the point in which a stock moves above or below a trading range. It moves out of a trading range, hence the term break out of a trading range. Okay? Yeah, Cliff, I hope the same. That was a great message, and I hope it resonated with some people. So now, the question is, we know what a breakout is, but what type of play is it? And the answer is momentum play. Okay? Momentum play. Well, there's some trades that are not momentum plays. A buy setup is not a momentum play per se. All right, a 3-bar play is a momentum play. A breakout is a momentum play. Why is it important we know the expectation here? Because if you don't know what type of play or trade you're getting yourself into. Now, when we say the word momentum play, what does that really mean? It simply means a trade that should hit and run. Okay? It's a trade that should hit and run. That's momentum. It's momentum based. The wave should carry that trade up, and it should do it rather quickly, right? Momentum plays don't chop around. Test your stop loss and then go, okay? Sometimes that happens, but that's not the general modus operandi of a momentum play. Knowing this should give you an understanding of how to approach the play as well as how to manage it. All right, so if you get into a breakout and it's not going, there's probably a good chance it's not gonna go. Let me repeat. If you get into a breakout and it's not going, there's probably a good chance it's not going to go. So you need to kind of think about the expectation. The expectation is momentum. It's not going. What do I do? Perhaps walk away. We'll get into that topic later. Okay, we'll get into that topic later. Now, same slide, a little different. Biggest reasons breakouts fail. They fail for two main reasons. Location and quality. They're the two main reasons breakouts fail. Location and quality. How did it get there? That's the quality. How did it get there? And where is it on the chart, the actual location? Okay, so here's one of the problems I see with people. You see this little brown circle over here on the bottom left right here? Right? Touching this blue line here. Okay, that's meant to be a moving average. That's the bottom of the consolidation. And when it breaks above the red line, that's the actual breakout. So yes, by definition, you could say this is a breakout. But is it a tradable breakout? See, how did it get there? What's the quality? Did it get above the red line after 5 straight bars in a row up? I'm not sure I want to buy that. Right? Look to the right over here. We have a stock that's in a stage 1. Moves up, pulls back, moves up, pulls back, moves up, pulls back. But note, on this pullback, it has a higher low. That's a good sign. That's good. But if you buy it at the red line, maybe it's been up 3, 4, 5 bars. Maybe it's a little tired. And then you might want to wait for the first pullback instead of buying the initial breakout. We talk about it frequently. The safest place on a chart to buy is the first pullback. This is the first pullback right here, where my cursor is, right? That is the first pullback area. The problem is most traders lack patience. And because they lack patience, they buy a stock after it has already broken out. And depending on how it got there, it might already be tired by the time it breaks out. Think about it. By the time it breaks out, it may already be tired, not making it not a high quality breakout. Okay? So those are two things I want. And don't get me wrong, we're going to have like 20 slides of examples. All right, we're going to talk about this in detail. Okay? And then you're right. They also get scared that there won't be a pullback to jump in. And you know what? That happens occasionally. But most of the time, more often than not, they do give you some entry somewhere, sometime. It is what it is. But you have to have the mental approach, the mental fortitude and attitude to know that that's going to happen. All right? So how they form, right, meaning how it got to the breakout area is the quality. Where it is on the chart is the location. So in this case, you may have a quality and a location problem. And if you're buying this above the red bar here, at the red bar, the location there is okay, but the quality isn't. Well, now you're not getting both. And you have to have both. You have to have both for a good breakout. One or the other is not good enough. Okay, one or the other is not good enough. So let's take a look at some examples here. All right. Again, a few of these you have seen, some of them you have not. So how did it get there? Where did it come from? Well, on the left, we always have our higher time frame because we always start with the higher time frame, multiple time frame analysis. So we have a stock that's been kind of in a range between $61 and $65, give or take. Chop, 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 chop. And now we have a stock right here. See the pink line? Okay. That is consolidating out right here at 66 bucks. And some people will look at that and go, Jared, look at the breakout. I had this conversation earlier today on a stock, looking at it on a 1-minute chart, and then I said, did you look at the 15? Do you guys remember that conversation? It was Airbnb, I believe. And I said, it's 5 bars down on the 15-minute. Not the best time to be shorting that stock. In this case, we're looking at this as a stock that's up 1, 2, 3, 4, 5, 6, 7 bars in a row. 7 bars into overhead supply. Pivot here, pivot here, pivot here, and a pivot over here somewhere. And you want to take this at the high of the day. Not by the pullback down here. You want to take it at the high. No. How it got there is terrible. And where it is, not the best either, really, because of how it got there. So this is stock that's really extended. And that you shouldn't be buying this. And yet, people are like, hey, it's a momentum play. I'm going to buy it. It's going to go up 8-9 days. Maybe. The odds are against it, though. The odds are against it. So what happened? It fails. This is an obvious one, in my opinion. But you understand the concept. How it got there is too extended. All right? A lot of slides to get through, so I'm going to have to go through some of them a little quicker. All right, here's another chart. Right? Stock moves up, pulls back, and retests the low here. Bounces about 50%, pulls back, bounces, pulls back, bounces, pulls back, bounces, and stalls again at that 50-75 area, and then does a massive 100% retracement all the way down to 48, less than 48. Then it bounces back up. Okay. So what's the expectation here? Right? What's the expectation here? See where my cursor is? I'm circling it. What's the expectation? Over the next couple few days, right? This is a 60-minute chart. The expectation is it's probably going to smack its head off of the 50-75 area, right? It's probably going to smack its head off this area. So what in a perfect world, I'm asking you about perfect worlds, what would you like to see happen here? In a perfect world, what would you like to see happen? Okay? I know exactly what I would like to see happen. What would you like to see happen? In a perfect world, if you could just write the future of this stock. You want to see one of two things happen. One is better than the other. Okay? Higher low is what a lot of people are saying, right? Make a higher low. That is one. Okay? Or consolidate out in the upper range for a few days, right? Consolidate at the top, all right? And there's one third one. There's a third one. Okay, so the first two we talked about is one, put in a higher low, perhaps pull back to 49.50 and then go higher. The second one we talked about was to consolidate out near 50.50, right? This area, $50.50, just consolidate out for a few days right in there, okay? But there's a third one. Yes, Chris, yes, 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 that is it. That's it. Break out, put in a new high. Just keep going up. Go to 52 and then pull back to support at 50.50. Yes, that is the third one. Well done, Chris. This is the third one. Break out to, I don't know, $52. We're not going to take the breakout. We're not going to take this breakout because it's too extended. But break out all the way up to here, pull back to 50.50, hopefully give us a proper entry, and then take it. And I'll be honest, I'm somewhat indifferent to any one of those three things. I really am. If it consolidates long enough at 50.50, I'd be willing to take it in that area, 50.50, 50.75, whatever that area is. If it puts in a higher low, okay, that's not bad. And then if it broke out and pulled back, I'm okay with that too. All right? So those are the three things. But the expectation is that it's going to bang its head off of 50.75 and go lower. That's the expectation here, okay? You want to be buying these things down over here. Look at the bottom left. You see the lower high, lower high, lower high, bottoming tail, doji bar, narrow body bar, etc. That's where you want to be buying these types of things. You want to be buying it over here, right? So over here at 48.50, right? And then next to it at 48.50. It bounced here. It'll probably bounce again here. Bounces, pulls back, bounces. Okay? Exactly right, Eric. It is range bound until it proves otherwise. So the expectation is for it to stay range bound. But remember, how it enters an area is very important. Okay? Next, it's like deja vu. We have another 60-minute chart that moves up, goes from like 37 to 38.40, chops around, chops around, chops around, and then gets a lot of buyers to come in over here on March 19th. Green bar, green bar, green bar, green bar, green bar, green bar, green bar. 1, 2, 3, 4, 5, 6, 7. Double top at 38.40. 7 green bars at 38.40. And what happens? Pink line. This is your breakout right here. Right? See where I'm drawing this? This is your breakout. Note, it's right around 38.40. What happens? Peekaboos. Pulls back. Peekaboos. Pulls back. Okay? You can't see it, okay? And I'm telling you this. I should have put it on here. My apologies. You can't see it. But 1 month later, this stock still hadn't broken 38.50. I know this is a 5-minute chart and this is 60 minutes chart, but 1 month later, it still had not broken 38.50. Okay? This is not the kind of 5-minute breakout you're looking to take. Even taking this buy setup right down here, buying the bottom with an engulfing bar is a very tough thing to do. You're going to have to be super scalpelicious on this, okay? Because of the higher time frame. So this is why people say breakouts fail, because you're taking crappy breakouts. Because how it got there was terrible, right? It got there in a very bullish manner, but an extended bullish manner. That's a problem, okay? I know, Matthew, come up with words all the time, right? So now, here's another one. Chop, 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 chop. Okay, I'm interested here. See this right there? I'm interested in trading this higher. To me, that has rested likely long enough. 1, 2, 3, 4, 5, 6 days. On the 7th day, I might be interested. But it tanks. Completely gets hammered. Chops around, gaps up, moves up. Now, I have no problem, to be very clear here, I have no problem with you guys taking this on this day right down here. See at 385, 386 area right there. If you can find an entry on a lower time frame, by all means take it. But what is your target? See, we're gapping over this little area 385. It's a smooth pullback, so the move back up should be smooth. What is your hard, firm target? Talk to me. If you happen to trade this thing, what's the target? I mean, it's an easy one, I think. There's a red line on it. 395. That's it. The resistance area above, 395. No more. No more. You don't want to be holding this above 395. I shouldn't say above it, but you get the point. You have to know what happens. Wide range green bar, wide range green bar, pretty good size. And then what? The last 4 bars of the day are narrower range bars. Momentum has slowed down here. It's extended into triple top resistance. So the momentum clearly suggests that that was a problem, this area. And then the stock being extended in that area is exactly where it should have stalled and should have pulled back. Now, again, this is a very obvious chart in my opinion, but this is not a breakout. So if you took it down here at 385 on whatever play, a buy setup, a 3-bar, that's fine. I'm good with that on a 5-minute chart, a 15-minute chart, 2, whatever. But when you look at the 60, you are not buying this thing at 396 or 395 as a swing trade. Yes, Jared, I'm going to go buy this as a swing trade. Why? It's extended into resistance. It may peekaboo over to 400, even 397, whatever, but it's probably going to pull back. Wait for the pullback. This thing's tired. Give it the time it needs. Respect the stock. You don't have to rush into it. There's always something else to trade. Right, here's another example. Daily chart. Stock rips up, chops around, and then just sells off. Okay? Gets a decent sized gap surprise right here, and that changes the whole direction of the stock. Okay? Moves up. Red line is the resistance area. Okay? $60.50, whatever it is, but it's up 1, 2, 3, 4, 5, 6, 7, 8 days. If you wake up in the morning and you see a gap, and this is the gap, or if you see the daily chart, you're not looking at this. The expectation is a pullback. And the pullback should, if the stock is strong, pull back to like $58, $58.50, 59, somewhere between $58 and $59. That's where this thing should pull back to. Okay? And if you can take a buy set up there and get 2 to 1 by the time it hits 60, then fine. Maybe hold half to see if it breaks. But this is too extended into double top resistance. Now, will it eventually likely break this area? Probably, yes. But not today. And if it does, it's probably going to peekaboo over and then stop you out. If the higher time frame looks like this, walk away. Put it on a backup watch list for, a week or 2 from now. Don't even look at it for 3 or 4 days, because the pullback's going to take 3 or 4 days and the resting period's going to take 3 or 4 days. Okay? Now, what do we have here? I think you guys saw this one last week or the week before. Exceptional technical understanding. 60-minute chart gaps up. Remember we talked about going long on this? And then it pulls all the way back to support. And then it puts in a double bottom. Are you going to short this at 48.40? I mean, the 60-minute chart, you're at the low of the 60-minute chart. This is a breakdown, right? This is a breakdown. Technically, it's a breakdown, because if it breaks below the low, it's breaking down below the low. So by definition, it's a breakdown, but it's not tradable. It was actually a breakout up here, right, at 50. And then it looks like a breakdown down here, but how it got there, look at this thing, 50 down to 40. You're going to probably buy this thing. You're probably going to buy the double bottom. Fascinating, isn't it? How a new trader who doesn't know what they're doing would short this at 48.40, and an experienced trader is going to buy the double bottom retest, not to make a home run, not to go back to $52, but to maybe get back to 49 or 49.20, 50% retracement. But I'm not shorting this thing under 48 or 48.50 unless or until this thing sits here for at least a few more days, minimum. Minimum. Because every single time it's tested this area, it's bounced. And 2 of those 3 times, it's bounced pretty heavy on big volume. Bottoming tails here, over here, hugely extended double bottom retest. Okay? This is a stock you're going to probably buy the bounce on. The selling pressure here isn't that great. Now, I know what you're thinking. What do you mean, Jared? This thing got hammered. I know. And all the people that wanted to get out got out. There's some people down here that took some profits, yes? Or I should say up here. So a lot of people bought this thing, and this thing moved higher. And they're like, sweet, that's what I got. I got the top of the base. Now I'm going to sell some off. Okay? This is not something you're going to be shorting. All right? Can you also comment on the point when a stock touches a support line numerous or many times? Well, if I had an example, I would talk about it, Kit, but I don't have an example in front of me. So I don't know that, I'd rather give you guys a visual representation of your question than just answer it philosophically, right? The point, though, is how it got there was very extended. Now, if I eliminated May 29th, May 30th, and June 1st, right? If I eliminated these 3 days, here, here, and here, right? Let's just do this, just for fun, okay? If I eliminated those days right there, can I make that bigger? Let's just do this. Let's eliminate that, okay? Then you could look at this as a possible breakdown under the pink line, right? Because it's holding near the lows, at the lows. It's rested for 5, 7, 8 days, right? Right in here. And then that looks like a good breakdown right there. But that's not what happened. Right? This thing went much higher, and then it's retesting after an extended move. Okay? What do you mean like this one? There's no trend line here on the daily that it's touching. So you're talking about a 5-minute trend line, right? And depending on when you drew the trend line, if you drew the trend line here, this is your trend line. So I'll show you. Hold on. I don't think this is a very good example of what you're trying to accomplish. But this is the original trend line right there, right? Take the highest point on the chart and the lowest. That's the original trend line, right? Really, it's actually over here, okay? That's the original trend line, and it double bottomed and bounced. And if you want to draw a new trend line, your actual new trend line is actually going to be something like this, right? That's kind of your new trend line. So again, I just don't think this is a very good chart for what you're trying to accomplish. I don't understand what you mean, I guess, bouncing off the trend line, because this is not bouncing off the trend line. All right. So the point, though, is that a novice trader would look at this and go, I want to go short. A professional trader is going to look at this and go, I want to go long. Okay. Yeah, touching support is not the trend line. Totally different, right? I was talking about the horizontal line of 48.50 support when it breaks. Right. This is a support area, right? And we just talked about that, meaning it's tested this area how many times, and every time it's bounced. And that's why I drew that blue box, because when it was over here on May 28th, you might consider shorting this because it's holding the bottom 50% of the range, which is what you want to see for general weakness, okay? But once it puts in these next 2 days, everything changes. It comes back up and proves that this stock is still very much range bound. And then when it gaps up, yes, it does look good over $50 to at least to the gap fill, and then it sells off. All right, now, because of how many times it's touched this area and bounced, and how it's getting to 48.50 on the 5-minute, I'm looking to buy it long. Absolutely looking to go long on this. Now, again, are we looking for $52? No. You're looking for anywhere from 49 to the high of the day, right? If you can get this back to 49 or 49.20 in that range, great. Okay. All right. Here's another example. We start with a 60-minute chart. Bounces, chops around, pulls all the way back, gaps down, bounces, pulls back, bounces, pulls back, bounces, and then it sells off. 1, 2, 3, 4, 5, 6, 7, 8, 9 bars down, 9 bars down. One more time, say it loud, 9 bars down, and one of them is a super wide range bar. So 36.50 comes along. We're at a double bottom support area right now, okay? And then the stock comes down and starts to consolidate right around 36.50, give or take. You shorting this bad boy here? Good trade? Yes or no? Yes or no? Talk to me. You're on the 5-minute chart. We shorten this at 36.50. I'd hope not. The 60's down 9 bars, one of which is a huge wide range bar, okay? And then you put this into play. You sit there and go, wow, I'm 9 bars down into a double bottom support area. We haven't even broken the support area, and we're extended into it. I need a lot more confirmation. And you know, also one more thing, real quick. I put this in here because I'm sure someone's thinking it, so I'm going to get it out of your head. That, ladies and gentlemen, boys and girls, this is not a, say it out loud with me. This is not a, type it in, say it with me. Thank you. It's not a 3-bar play. Thank you, Chris. Thank you, Jerry, Dean, Kelly. Thank you. This is not a 3-bar play. It is extended, so it can't be. And 2, it's sitting above support, double bottom support. I know there's a few of you out there that are thinking, ooh, look at that 60-minute 3-bar play he's missing. Nope, not missing it. It's down 8 bars in a row, and it's just above support. Not a 3-bar play. Not a 3-bar play. Okay? This is something you want to stay away from as a general rule. And here's the problem. Every once in a while, one of these will go much lower. Right? This thing right here at 36.50 will go down to like 35.50. It'll go down to this area. Every once in a while that will happen. And then people use that as a justification to do it again. And then it's not going to work the next 5 times you try it. This is not a good short here. It's not a good short. All right, it's either a shallow bounce long or a leave it alone until it rests longer. Okay. Now, let's change gears a little bit. All right, let's change gears a little bit. Start with the higher time frame. Notice the difference. Okay, notice the difference. 60-minute chart, 91 to like 92.50. Tight, narrow range. Yes, it's a little sloppy inside that range, but it's still a tight, narrow range for a $91 stock. Now, do you guys remember right out of, have a good one, Michael. Do you guys remember right out of Professional Trading Strategies, what is the general difference between a stage 2 pause that refreshes and a stage 3? Do you guys remember? Stage 2 pause that refreshes, which is a stage 2 that consolidates and goes higher, versus a stage 3. Okay? And I agree, Cass, you must know your exit before you get into the trade. I agree. Okay? Volatility is definitely in there, right? Tight versus wide and whippy. That is it. Okay? So when you look at something, right, and let's go back a couple slides just real quick to show you the difference. Okay? When you look at something, this is more looking like a stage 3. Again, it's hard to say because we don't have more information, but it's wide and more whippy and wild and wider range. When you come down to this over here, okay, this is much tighter. Now, it's not super clean, but it's much, much tighter. The range is tighter, right? The buyers are coming in very quickly here at $91. So you wake up the next day and you see this. All right, you see this. So note, this is the 60-minute chart. Now, to be fair, I want to be clear here. Some of you are going, but Jared, it's at, 92.25 here, but over here it's at 91. My 60-minute chart starts at 9 a.m. My 60-minute chart starts at 9 a.m., not 9:30. Okay, that's why you're seeing a discrepancy between this here at 91.50 and this here at 92.25. My 60-minute chart starts at 9 a.m. So some of this is pre-market. Okay, some of this is pre-market. So you wake up and you're looking at this and you're going, ooh, wow, 1, 2, 3, 4, 5, 6-day consolidation. Gap up. There's the red line we need to be above, roughly 92.50. Roughly 92.50. Wide range bar, narrow range bar, boom. Now, I would honestly hope to find a better entry here, right? Because it's moved up $1. That's a pretty good move. Maybe you could consider that a little bit extended. But guess what? There are 2 trades here. This is a good 60-minute breakout. This is a 60-minute breakout that you take at 92.50 and you put your stop at $91, and now you hold it for the next week, the next 5 days, 7 days. This is a good example of a non-extended breakout. Stage 2 pause that refreshes, and it's triggering in a proper manner. Why? Well, 1, it's a tight consolidation, and 2, it's triggering from the midpoint of the base, not the bottom of the base, so it's less extended. So this is actually a good swing trade, right? A good swing trade, and possibly a good 15-minute trade. All right. If that was a 20% gap, what would you think? If it's a 20% gap, I wouldn't touch it. I'd probably just try to buy a big old pullback or wait. 20%? Realize, Aaron, 20% is $18. That means this thing would be at $110. $110. Your target's probably $110. So you want to buy it at your target? I probably wouldn't. You know, and you're right, Dean. If you took this at 92.50, right? You could add on your swing trade at 93.50. Have a cost average of $93 and possibly raise your stop up below the current day's low. You're absolutely right, Dean. You could do that. Okay. Now, see the difference here. Daily chart. What do we have again? Nice, tight, narrow range from $28 to $30. Tight range. Note, it's above the moving averages, right? Rising moving average, rising moving average. It's above the moving averages, consolidated back towards the moving average. When we talk about breakouts in the Professional Trading Strategies book, it says it doesn't have to touch the moving average, but we'd like to see it get back about 70% of the way to the moving average. Well, this one actually touches the moving average. Great. Guess what? Two trades here. One, there's a daily breakout at 30 with a stop loss at 28. Great. Or if you're not swing trading, you drill down, wide range bar from 29 to 30, narrow range, narrow range, narrow range, bam, there's your entry. There's a possible add. But you get in at 30, your stop's at 29.50, boom, 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 goes to 32 by the end of the day. If you took the swing trade, you're up 1R by the end of the day, which is always wonderful on a swing trade. If you can get an R or two in the first day, amazing. So the swing trade's already up an R, and if you intraday traded it, you're already up a lot more than that. You're up 4R. And really the stop loss is much tighter than 50 cents. It's really more like 30 cents. You could do both. An intraday swing trade you could also do, couldn't you? This is matching your time frames, and it's also not just matching the time frame, but you're using the quality or a high quality breakout here. How did it get here? After a nice tight consolidation and a non-extended move. And then you get the volume. Oh, man. Very, very nice. There's a lot of interest in this stock. Now, we have kind of what we talked about earlier. Stock that's higher here, pulls back, bounces, pulls back, bounces, pulls back, bounces, consolidates. But note, up here, it fails on the breakout because it's tired. So over here, this is the breakout right there, like 188, 189 right there. That's the breakout. But it got to that area a bit tired. It peekaboos up, pulls all the way back, chops around. Guess what? It's tired again right here. Note, it was tired over here. It got back up and retested that area after 1, 2, 3, 4 days up. I'm not buying that right there. It's just not enough resting period. Peekaboos, then it rests back to the moving average, right? 70% of the way? No, in this case, it touches the moving average. Another 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13-day resting period. Now it's rested long enough. You're going to get in at like 195, but you're stopped below the low of the base, which is probably 190, and the first day you get about 1R. Bam. Right? Tired, well rested, and decreased volume in the consolidation. Yes. This is what a good breakout looks like. And good breakouts take patience. This is why people say breakouts fail, because technically this stock broke out over here on the left. Why? It broke above a prior pivot high, which is technically by definition a breakout, but it's not a tradable breakout. And then it fails. And over here, same. Broke out above the prior, but it's not tradable. I think you guys have seen this slide before. Okay, I've used it before. Stock goes higher, pulls back, bounces, and then just sells off. Goes from 93 all the way down to 74. Bounces. Tired. It's getting to the prior pivot area after an extended move. Pulls back, bounces. It's getting to the prior double top after an extended move. And it's far from the moving average. 1, 2, 3, 4 days up, double top. It's tired. Don't take this breakout. But many of you do. And then it goes 1, 2, 3, 4, 5, 6 day consolidation back to the moving average. The pullback has created void. This is your breakout. So you're either going to take it as a swing trade at 83 with a stop at 81 or 80, whatever that area is, right? Buy it here, stop down here. Or you're going to look for an intraday trade and drill down and find an entry. That's a great breakout. Breakouts are fine. Breakouts work all the time if you use the right ones. Here's the one on intraday. Okay, stock moves above resistance to the left. I should have put the higher time frame on here. I apologize, but it's the same concept, just on a lower time frame. What happens? The stock chops. Now again, I'll be fair. I don't mind you guys nibbling some of this thing at like 85.25 down here. It's at support. It's tested support here, right? See that area there? It tested support. Retest here. It's at the moving average. I don't mind you nibbling some at 85.50. I don't. But if you're looking for that perfect clean pattern, you're going to wait till it breaks the high of the day at 86. But you don't want it to break the high of the day here because it's 3 bars up. It's 3 bars up right there. I don't want it to break right then. Then it rests 1, 2, 3, 4, 5, 6 bar consolidation back to the rising movement. Remember, it doesn't have to touch it. Just get most of the way back towards it, 70% of the way. Beautiful tight consolidation on a stock that was already showing some strength. You're going to get in at 86. Your stop's going to be down at like 85.80. Rip. I mean rip. $2.50. Look at the volume spike. Look at the interest. Look at the commitment. Okay? So again, I don't have a problem. You want to buy some of this at 85.50. Put your stop down here at 85. Add back to the trade at 86 and go. But you're not adding back at 86 right here. You're adding back at 86 over here. There's a huge difference between this 86 and this 86. Big difference. Whew, they don't get much prettier than this. Higher time frame 60-minute chart. Stock is breaking below this area. Okay. Note on the 60, it's important. 1, 2, 3, 4 bars down. Well, it's kind of hard to take this breakdown right off the open, isn't it? Because the 60-minute chart is 4 bars down. So what do we ideally in a perfect world want to see? We want to see the stock rest, catch its breath a little bit. Well, in this case, we got very fortunate because not only did the stock break below support, it gave us an hour and a half of rest in a narrow, tight range, topping tail, just hanging out, chilling out, back to the moving average in a super narrow range. So it allowed the 4 bars down here that were a bit extended to consolidate for a little bit. In this case, about an hour and a half, a little bit more than that, really. The market was also weak at that time. The market was breaking down at 11 a.m. right here. So you have the market in alignment with the higher time frame of the stock, and the stock on the lower time frame gave you a perfect pattern. It's putting it all together. This is perfect trading. Below the moving average, back towards the moving average, narrow, tight range. Higher time frame has room to go lower and has rested, and the market is weak. Bam. You're getting in right there at like, I don't know what that is, 54.60, and this thing drops to like 53 bucks. Or there it is, 54.50. Okay, 15-cent stop. You could have given it more room if you want. Stock drops $1. Dropped $1.60. 10 to 1. Put it all together. Another example. You guys have seen this one. Stock's in a downtrend, 60-minute downtrend. Consolidates for 1, 2, 3, 4, 5, 6, 7 days in a row. 7 days in a row. What do we get? Wide bar, narrow bar, drop. Now, this isn't really a breakdown, but the daily, 60, the 60 is a breakdown. So just because the 60 is a breakdown doesn't mean we can't use a different pattern on the lower time frame. Maybe you want to use a sell setup. Maybe you want to use a 4-bar play. Maybe you want to use a breakdown. In this case, it was a 3-minute 4-bar play, right? Breaking down under this area. Support is broken, room to drop, right? It could be a 1-minute breakdown. You're right, Chris. But what are we doing again? We're matching the time frames. And then what happens? It drops a lot, and you get this little double bottom retest. And over here around 11:30, you might, I stress, be able to go long on this on a micro time frame. But it all started with the 60-minute breakdown, right? Would you have put your entry under the tail? It depends how the tail formed, right? So if this tail was a clean move back up, Aaron, where it was just mainly, green or red bars that turned into green bars, you know what I mean? A clean pullback like something like this right there, then I'm not worried about the tail so much, right? Because of how it formed. But also, if you take a look at this, you're getting in at, I don't know, what was it, 23.10? Take a look at the entry. It's pretty much 23.10. Look at the tail. This dotted gray line is $23. The tail is right almost exactly at 23.10, right? See it right there? Almost exactly at 23.10. That means it's a perfect trade. I think, if I recall, it was 23.08. If I recall correctly, I think that bottoming tail low was 23.08. I'm still taking it at 23.10. Okay, now, same idea, but a little bit different. So now the daily is not the breakdown. We're using a different concept on the daily. The daily concept is a novice gap up, right? 1, 2, 3, 4, 5, 6 bars up, mega gap, maybe not mega, but very big, from $44 to $48, 10% almost on the gap after it's already 6 bars up. This is a novice gap. I'm looking to go short. I'm looking to go short on a breakdown, a 3-bar play, a sell. Well, in this case, we got a breakdown. On a 5-minute chart. You want to use a 2-minute or a 1-minute? It's probably an even bigger, better breakdown. Novice gap, extended daily chart, room to go lower. There it is, $47, stops $47.50, boom. It goes down to, I don't know, $45.70 or whatever it is. So again, the daily in this case wasn't a breakout or breakdown, but the lower time frame was. So you can mix and match those. It's nice when you get both time frames looking exactly the same, but you don't have to, as long as they're both PTS concepts. So we used a different type of daily chart, but still valid, and we used a lower time frame breakdown. Okay? Yep, but it had room, right? It had, I don't know, $1.20 on that 200 MA, So expectation, exactly right, Dean. The expectation is to hit the moving average at 46-ish, give or take. Okay? 46. Yesterday's gap was definitely not a novice gap. It was a gap and crap. Right, that's what I would call it, a gap and crap. It gapped up and sold off. But it wasn't any type of professional gap. It was too big. 4% in the market's huge. Okay? Are we not waiting till the candle closes to take entry? What time frame are you talking about, Sean? Specifically on this chart, what time frame are you talking about? Remember, guys, in today's lecture, we've mixed and matched intraday trades with swing trades. Right? So in this particular case, no, I am not waiting for the daily chart, right? I'm not waiting for the daily chart to close. I want to take this thing early in the day, in this case at 10:15, right? The daily chart is what I'm basing my lower time frame trade off of. So when this thing, the second it breaks $47, once it gets to $46.99, I am entering this trade lower. The second it gets there. Maybe it consolidates for 4 more bars before it breaks, but the second it breaks, I'm getting in at 47. Okay? If you trade a 5-minute breakout, in what way will you use the 1-minute time frame to understand its quality? In all ways. So for example, Matthew, I haven't read the rest of your question, but if I want to look how the breakout formed on the 5-minute, I'm going to look at the 1-minute. Is that a bottoming tail? Is that an engulfing bar on a 1-minute that becomes a topping tail on the 5-minute? You're always using multiple time frames to look inside the bars. How did this little shakeout form? I want to know. What does it look like on a 1 or a 2-minute chart? Was there a volume spike there? Was there a little retest on the pre-market on a 1-minute? I don't know. You're always looking at multiple time frames. Okay? You want to look inside the candlesticks. Now, summary. A breakout is the point in which a stock moves above or below a trading range, usually away from support or resistance. But what type of play is it? Now, why am I bringing this back up in summary? Because there's one thing we didn't talk about. Breakout management. I could do a whole nother lecture on that, but I'll give you a couple tidbits today. If you get into a breakout, a proper breakout, not these crappy ones, a proper breakout, and it doesn't go immediately. If it doesn't go a quarter to a half of an hour immediately, you might want to double think staying in it. Okay, now there's more to it than that. Does it have a volume spike? Was there a news report that came out? Did the market just turn around and go big red bar? Like, there's other factors to consider. But if nothing else is extreme, meaning the market is staying the same, there's no crazy news coming out, and you get into a breakout and there's not a lot of volume and it doesn't go higher, run. I've said it in past lectures, and Professional Trading Strategy says this frequently. Okay? Breakouts are momentum trades. All right? So the volume on the breakout tells us how it's happening. The price tells us what is happening, higher or lower. The volume tells us how. And that volume means commitment or lack of commitment. Okay? So when you think about it, a breakout that lacks volume and doesn't go higher has no commitment. Okay? When you think about a breakout that has big volume and doesn't go higher, what's the problem there? Think about it for a moment. Imagine you do have a breakout by a few pennies and there's a massive volume spike. It means there's far more sellers there than we thought. See, traditionally, when your stock breaks through a range, right? When it breaks above or below that trading range, the reason it's breaking above or below that trading range is because the battle was fought. And theoretically, the battle was won by the buyers, right? If you take a look down here and you're tug-of-warring it right here, back and forth, buyers, sellers, buyers, sellers, buyers, sellers, tug-of-war. When you break above this red line, theoretically, the sellers lost. Right? It was in a range. We broke the range. So theoretically, the sellers lose. So if you get into a breakout, it has heavy volume, big volume, but no price movement, oh shit. Right? That's an oh shit moment. That's one of those where you're like, there's more buyer or more sellers here than I thought. The stock's probably coming back down. That's one of the worst things you can see. A massive volume spike with little to no price movement. Danger zone. Run. Every once in a while, sure, it'll still go. But most of the time, which is what we're after, 80+% of the time, it's not going to work. So when you're thinking about breakouts and breakdowns, it's a momentum play. And if it doesn't show you momentum very early in the trade, in the first minute or two, again, assuming an intraday trade, a daily is different, but assuming an intraday trade, if it doesn't show you some momentum, some price movement in your intended direction, quarter hour, half hour, walk away. Lighten your load. It's probably not going to work. Okay? So don't forget where it happens and how it got there. Where it happens and how it got there. Okay, so I hope you guys learned a little bit about breakouts in terms of what a good breakout looks like versus what a bad breakout looks like. Because remember, a stock can break through a range but not be tradable. I'll repeat, a stock can break through a range and not be tradable depending on how it got there and where it is. Okay, so it's very important that you match the higher time frame with the lower time frame and make sure it's getting to the breakout area after either a long, lengthy consolidation or a reasonable pullback that has a higher low. Okay, you don't want to be taking these things, 5 bars up into the breakout. All right, so keep that in mind. And the last thing we talked about briefly was management. They're momentum trades, and if they don't give you momentum, they're not likely going to. All right, so I'm Jared Wesley of Live Traders. We'll get back at it again next week.